Hello, this is producer Cam bringing you a sneak peek from our most recent cash flow club where Coach T gives you a breakdown of the strategy known as the straddle.
But before we get into the risk graph, and really I do want to teach the strategy a little bit, right? First thing I want to do is I want to draw a risk profile. Every technique you ever have, you should be able to draw the picture, okay? This is called a risk graph. Everybody type in risk graph in the chat. What a risk graph is doing, and it's a good test. I mean, do you understand the basic nature of how you make and lose money, right? There's several things about a risk graph that you need to understand. This line right here, and we'll reduce the size down. Bring this down to about 12. This is called a break-even line. Okay, so what the trade is trying to tell you is that if the trade goes down here, this is where you lose, and this is where you profit. Okay, so in this example, we can profit if the stock price goes down or if the stock price goes up. This is called a bi-directional trade. Now, there's several things I like to define when it comes to a strategy. And I have my own ways of doing this when it comes to risk profiles and building playbooks. By the way, everybody should have a copy of that master playbook. If you do not, hit up Cam, team at Tackle Trading. He can hook you up with that. But there's a straddle page in that playbook that describes what it is you're going to do. I'm going to give you the condensed version of that as we talk through it. Now, the first thing is the philosophy for me. Okay. What is the theory behind a straddle? Essentially, why do we do it? What is the reason why we use a straddle? Now, there's a longer explanation, a little bit more verbose explanation in that playbook, but I want to keep it super simple. I want to make this to where it's not too hard, right? The theory is basic, to profit from the rise in implied volatility prior to earnings. That's it. That's the reason we use it. We're trying to make money because implied volatility will go up before earnings. Okay, that is the mindset. Type in the word KISS in the chat. KISS. See, there are different factors that we can use to go out and build a trade. Time decay, that's theta, that's cash flow, right? You sell a naked put, you do a covered call trade, you do a bull put spread, bear call spread, iron condor. These are theta strategies. Go review, Trading Justice episode 220 if you want to learn more about theta. There's tons on cash flow. We love cash flow. But there's another way to make money, and that's volatility changing. And volatility will rise and it will fall, and it will rise and it will fall. And that will have an impact and make an impact, on the value of the options. And Keith C just sent me a private message. Of course, yeah, get a copy of that playbook, email team at Tackle Trading, and Cam will attach it and send it back to you, okay? Now, the theory to profit from that rise in implied volatility, we then got to build the trade, and that's where it comes down to certain things. Now, these are things you're going to see in the playbook, like things like technical bias. And let me ask you guys, do we care what direction the stock goes when we do this? So that's where it says none. We do not have a technical bias, okay? We're not bullish, we're not bearish, we're not even neutral. We are bidirectional and volatility positive. I know those might be new terms, right? But we don't care where it goes. Up, down, sideways, as long as volatility builds, we're happy. Okay? Type of strategy. Now, in any option strategy, you can have it be impacted by everything. I mean, obviously, time decay is going to impact the options. I always tell this in my workshops. There's only three things that go into an option contract: time, terms, and price. And one of the ways that terms are set is based on volatility. Kind of like your car insurance. If you got an old history of driving crazy and speeding tickets, you got to pay more, right? That's a high implied volatility. But if you haven't had a speeding ticket or a wreck on your record for 25 years, you've got a low implied volatility. So what what would we label this strategy? Would we call it a delta strategy, a theta strategy, a vega strategy, or a gamma strategy? There's only 4 types. This is vega. Vega stands for volatility. We'll get into the Greeks here in a minute. Now, all we're doing there, guys, don't let that get too overwhelming. All we're doing is trying to label it and categorize it. So when we kind of go back to our playbook, we have a rule for it, okay? Delta rule. Now, the reason we use delta rules is simple. You can't argue with a number, right? I've been teaching beginners and intermediate and advanced traders for a long time, and I know this. You know, when you use vague phrases like out of the money, at the money, in the money, that's not defined. So we came up with delta rules. Now, the delta rule is simple. Closest to 0.50 delta per contract at the same strike for call and put. So type in 50 delta. Just type in 50 delta. What we're looking for now, Suki, why is it not delta? It is movement in price. No, it is movement in volatility. Now, Suki, it's a great question. A movement in price can help the trade, but we don't call it a delta trade because we're expecting the volatility. And let me maybe give you an analogy here. Suki, do you know football at all? Do you know football? The game, American football, not that stuff you guys play internationally called soccer, right? I grew up in the States, all right? Okay, so American football, you know American football. All right, can you think of a, like let's say a passing team? Like a real popular team that throws the ball a lot. Anybody, can you think about it? Give me one, a really good, like the Saints, right? Very good, the Saints, Drew Brees. Drew Brees and the Saints, or even the Patriots, Tom Brady, right? They throw the ball. So we're going to call them a passing team, right, Suki? But does that mean they never run the ball? No, of course, they still run the ball and pass the ball. So when we call this a Vega strategy, it doesn't mean delta doesn't play some role. What it means is that Vega and volatility are the primary philosophy behind the trade. Right? It's the vertical passing game. Does that make sense? Right? So yeah, you still have a split between run and pass. You still have a split between some of the delta. We just call it Vega to kind of lump it into a category, right? To explain it and put it in our playbook. All right, very good. Okay, type in the word learning if you're learning, right? I love coming in and doing these cash flow clubs, guys. I don't always get to do them, getting to work from home this week and not out there on the road right now, and I get to kind of come in and do this. So hopefully I can impact you guys. All right. So then the next thing is, and these are all in your playbook, by the way. I'm just going through them so you understand, and I'm simplifying them. The gamma rule. Now this one is where the playbooks can get a little confusing sometimes, and I think that we need to clarify this. In the playbook, it says less than 14 days is a hedge against credit. The actual gamma rule is none, okay? Use gamma when using the strategy to hedge another trade. Not applicable if entering as a first entry and independent trade, okay? So there is no gamma rule for the strategy. It doesn't have to have a certain number of gamma. But gamma describes how volatility can impact delta. I do not want to make your head spin. It does not have an impact on what you should do here. So we're going to put the word none there. So don't worry about gamma on this one for right now. Now, the Vega rule is to buy the straddle when IV percentage is low relative to its historical average and expected to rise. So that's where the rules come in, 4 to 6 weeks out, all that kind of stuff. Now, this is the theory behind the trade, okay? This is the theory behind the trade. What we're looking for, how we're looking for it. Now, let's talk about how to build it. Now, this is where I use the word construction, okay? Construction. When we build these, there's several things that you need to kind of play into account. I would say number one is that you want to buy +1 call and +1 put, okay, keep contracts balanced. Use closest to 50 delta at the same strike. It's generally the way you're going to play it. Now, 2 to 4 months out in expiration. Do not position size past your personal risk rules. Okay. And generally, I would say less than 5% of account, even when you're aggressive. So you would never go out and put your whole account on a trade like this. I would say most traders would do about 1 or 2% on the straddle because it's not a trade you have to micromanage. Now, that's the way we build them. We're going to go build those 3 together, one at a time. Now, the other thing is management. And this is where, honestly, I think that traders need more work on management than anything else. And you need to have a stop loss, okay? You need to have a target, and you need to know exactly what your entry is. Now, the stop loss for me is going to be set based on the target and take the exact target and set an equal distant stop loss from the entry. That will make more sense in a minute. This should not exceed 50% of the cost of your trade. And that's kind of the skinny with the stop loss. Guys, I'm a huge believer. 1 to 2% of capital or risk, Ethan, depends on how you're going to manage and build the portfolio. When in doubt, less risk is really the bottom line. I was talking to Hector today, and by the way, Hector is a great member of our team. I don't know if Hector's here tonight. Hector and I were on the phone chatting, and we're talking about risk. Actually, Hector is here. Everybody say hi, Hector. And the one thing I told Hector, I said, Hector, more than anything else, you're doing an awesome job with those morning reports. I can tell you're going to be a fantastic trader. Remember and never forget, the most important thing you can ever do is manage risk. Every one of you can learn these strategies. Even the straddle. If you've never traded a straddle, it's just new. It's not complicated. Okay, it's just new, right? Every one of you can learn these strategies, right? It's about controlling the risk and understanding the cost. Now, you do have risk. You can lose some money, but every type in I own risk, right? I own risk. You have to own the risk. You have to control the risk so that you can profit from the risk. And your risk should not be more than about 1 or 2% of your capital. So that's going to set the standard. Now, the target. The target has to be done, and this is what I'm going to tell you, done by using the projected price up or down, volatility expectation, and set to a risk profile. Offset by time decay. This is the way I do it. Now, that's going to sound complicated. So what we're going to do tonight, and the reason we did this as a part 2, like in TV when they say to be continued at the end of the old Cheers episodes. Tuesday was the first episode. This is the to be continued. So what we're going to do is we're going to go take those 3 candidates that Matt and I found from before. We're going to go build them in the risk profile, and I'm going to help you understand how to set the stop and target. Because how to build them, you guys have playbooks for that, right? And you also have 20 minutes already on this show on how to do it. Now we need to learn how to manage them. And that is the big thing.
I hope you enjoyed. Get to tackle trading now and check out the scouting reports that come out every weekend. Check out the blogs. And if you're not a pro member, go to tradingjustice.com and sign up for a free pro membership on us by clicking the banner.